Critical Man Pictures presents the Forex video training series, Purple Belt course, Introduction to Trading Divergences. The question that aspiring traders ask is, what if there is a low-risk way to sell near the top or buy near the bottom of a trend? There actually is. It's called divergence trading. In simplest terms, divergences can be seen by comparing price action and the movement of an indicator. It doesn't really matter which indicator you use. You can use RSI, MACD, stochastic, CCI, etc. The great thing about divergences is that you can use them as a leading indicator, and after some practice, it's not too difficult to spot. When traded properly, you can be consistently profitable with divergences. The best thing about divergences is that you're usually buying near the bottom or selling near the top. This makes the risk on your trades relatively small compared to your potential reward. The theme to keep in mind is higher highs and lower lows. Price action and momentum normally move hand in hand. If the price is making higher highs, the oscillator should also be making higher highs. If the price is making lower lows, the oscillator should also be making lower lows. If they are not, that means price and the oscillator are diverging from each other, and that's why it's called divergence. Divergence trading is a great method to use because it signals when something fishy is going on in the market, and that you should pay closer attention. Using divergence trading can be useful in spotting a weakening trend or reversal in momentum. Sometimes you can even use it as a signal for a trend to come. There are two types of divergences, regular and hidden. Regular divergence is used for a possible sign of a trend reversal. If a price is making lower lows, but the oscillator is making higher lows, this is considered to be bullish divergence. This normally occurs at the end of a downtrend. After establishing a second bottom, if the oscillator fails to make a new low, it is likely that price will rise, as price and momentum are normally expected to move in line with each other. Now, if price is making a higher high, but the oscillator is making a lower high, then you have regular bearish divergence. This type of divergence can be found in an uptrend. After price makes that second high, if the oscillator makes a lower high, then you probably can expect price to reverse and drop. As you saw in the images, the regular divergence is best when used to try to pick tops and bottoms. You're looking for an area where price will stop and reverse. The oscillator signals to us that momentum is starting to shift, and even though price has made a higher high, or lower low for that example, chances are that it won't be sustained. Now that you've got a hold on regular divergence, it's time to move on and learn about the second type, hidden divergence. Do not worry, hidden divergence is not that hard to spot. The reason it's called hidden is because it's hiding inside the current trend. Divergences not only signal a potential trend reversal, they can also be used as a possible sign for trend continuation. Always remember, the trend is your friend, so whenever you can get a signal that the trend will continue, then good news. Hidden bullish divergence happens when the price is making a higher low, but the oscillator is showing a lower low. This can be seen when the pair is in an uptrend. Once the pair makes a higher low, look to see if the oscillator does the same. If it doesn't and makes a lower low, then we've got some hidden divergence in our hands. Lastly, we've got hidden bearish divergence. This occurs when price makes a lower high, but the oscillator is making a higher high. Now, you've probably guessed this occurs in a downtrend. When you see hidden bearish divergence, chances are the pair will continue to shoot lower and continue the downtrend. To recap what you've learned so far about hidden divergence. If you're a trend follower, then you could dedicate some of your time to spot hidden divergence. If you do happen to spot it, it could help you jump into the trend early. Just keep in mind that regular divergences are possible signals for trend reversals, while hidden divergences signal trend continuation.